In late August 2021, two portfolios were presented. One was an equal-weighted portfolio with a primary focus on dividend yield, and the second was a very similar, fairly valued portfolio, equal-weighted, but focused on growth. Let's take a look at those portfolios today and update them and see how they've performed going forward. Hello, everybody. This is Chuck Cardinal, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. Late August, I put together a couple of portfolios. Actually, I put together three. I'm only going to be showing two on this video because I've been asked to update those. In August, one that I built was for growth, and one that I built was focused on income. Now, both portfolios were comprised of what I considered undervalued or fairly valued dividend growth stocks. But the one portfolio, the difference in the two was one portfolio was focused a little more on yield. So this is the one that I focused on yield, and you can see the dividend yields were high, 3%, 2.75%, 7.5%, etc. The other portfolio that I built was focused more on growth, and I called it equal weight growth model. Here you see lower dividend yields, but simultaneously higher potential capital appreciation. Now, I said that I was going to put those into our money management software, and I did that, but I do have a problem. Since they're not real accounts, no way for me to update the dividends and so on. So the best I can do for you is take these portfolios and look at them through the lens of Fast Graph, where we have applied a dot where we purchased the stock. Okay, and you can see that by the green dot here. And this was on, as you can see, on August 24th, 2021. And this was Abbvie. Okay, and this was the equal weight model for high income. But by the way, even the high income has a growth component, so keep that in mind. And what I'm going to do here is I'm going to go through these on a very high level and just let you see by focusing on the dot how undervalued these stocks were and then how they subsequently performed. But I want to make another point. It's been less than a year. This is only March. We got April, May, June, July, August. We got 5 more months. So this has been maybe 7 months into this equation. That's really much too short a period of time to really judge. But this will give you a good perspective on how these stocks have performed. As you can see, Abbvie has performed very well. Not only has it given us a really nice dividend over this year's time, but it's also given us really good capital appreciation. The next stock I'm going to look at is Amgen. And again, I want you to see that Amgen was undervalued. You can see how the price correlated. It was undervalued. It actually dropped immediately after being purchased and now has risen to a slight capital appreciation. And, we're getting somewhere around 3% on Amgen. The next one was Franklin Resources. It looked very undervalued at the time, and it actually was. You notice how it recovered and then dropped. And the point I want to make is that you're looking at two valuation references here. You can look at the performance based on the company's operating results and the dividend, and you can also look at the performance solely based on the stock price. And the stock price is very volatile, as you notice, but the earnings and the dividend lines are much less. Now, Ben Franklin was actually one that actually dropped in this case, so we didn't get much in the way of capital appreciation, but we did get nice income from it. Cardinal Health, a 3% payer, you can see once again how it's performed since that time frame. It was trading at a normal valuation for the last several years. It's now, gone up quite a slight amount. It's still undervalued even today, as most of these stocks continue to be. So Cardinal Health looked good. Chemours was another one that gave us a nice dividend yield. You can see it initially dropped, then it rose, then it dropped again. I want you to focus on the volatility we're seeing in these short periods of time, but yet earnings have grown and the dividend has really stayed the same in this example. But, that's the focus on what the income is doing, what the operating results are doing, as well as, what the earnings and dividends are doing, as well as what the stock price is doing. Note that the stock price is always a very volatile line. Drops, rises, drops, rises, drops. Okay, and ended up in Eastman Chemical about the same. So I'm going to quit kind of talking here for a moment and just kind of let you look at these stocks and just see the perspective that I've laid out for you right now. and see how these things have performed in this very, very short period of time. Some, like HP Inc. or Hewlett-Packard, if most of you would know it by, has performed extremely well, right from the get-go. Ingredion, performed really well and then has given that performance back as we've entered this bull market here in 2022, keep in mind. JP Morgan has not performed very well from a standpoint of operating results, but the dividend has continued to grow. And the point is, we're looking at this stock out here for 2 or 3 years out. But you can see right now you'd be underwater on this one, but you did get a nice dividend income. If you were to sell it today, you'd be underwater. Altria, the old Philip Morris, has really performed very, very nicely. And you can see over historical time frames, as I showed you this, I've featured this stock in several videos, it traded really in line with its operating results. There's always that volatility that goes along with that. Then it got overvalued, which ultimately corrected into undervaluation, and it's staying undervalued, but we've got actually a little profit and a real nice, 6% plus dividend yield, which is very interesting. Merck, has been kind of volatile over this period of time, but it's slightly in positive territory today. If you look at Omega is actually down. You got to look at Omega from a standpoint of funds from operations. It has dropped, but it is giving us a 9% dividend yield, which is taking, a lot of the pain away from a standpoint of what's happening to the stock price. Omnicom initially dropped and now it's up a little bit, so you can see, to shorten the time frame, you can just get a little better picture of how this has performed. Keep in mind the earnings and dividend line is much more stable than the price line. Principal Financial Group has been a good performer during this time, over a 3% dividend yield. It is up slightly, but it's been up more than that in a short period of time. But again, I want you to get the perspective that it's too short a time frame to measure these. Now, this one's interesting. This is South Jersey Industries, and I want you to see that it's a utility stock. Not a lot of growth, even went through a period of time here with poor growth, even though the stock price was really highly valued. We purchased it when it was at fair value, or theoretically purchased it at fair value. And now the stock has risen because it's going to be taken private. And I think it's $34 a share, which is approximately, where the stock might be $36 a share. But the point is, this is not, normal trading. This is actually reaction to a major announcement where this stock is going to be taken private. So that's South Jersey Industries, but yet it's been one of the best performers. But keep in mind, that was a totally unknown factor when we originally decided to put this into the portfolio because it had good yield, a very high yield at the time. Today it's still yielding 3.65%, even though it's much higher. But that's really an anomalous situation because the company is going private. UGI, in contrast, a gas utility, with all this been going in oil and gas, it is down rather substantially, but I think it's extremely attractive today. VICI Properties, which is an experiential REIT, has, underperformed a little bit, but it's giving us a nice 5% dividend yield. If you take a look at Verizon, Verizon is underperforming. It gives us a nice 5% dividend yield. And that is supposed to be Walgreens Boots Alliance. I put the wrong symbol in. I put the old symbol in, but I'll just correct that. You can see Walgreens Boots Alliance has actually just really marked time, but it's given us an excess of a 4% dividend yield. So that's the portfolio that was the equal weight model with a focus on income. Now, if I go to the portfolio that was focused on growth, I have much lower dividend yields for most of these stocks, but I theoretically have higher potential to make capital appreciation. So let's go ahead and measure that and see how that actually panned out. If you look at Ameriprise was undervalued. It's continued to grow earnings, continued to grow the dividend, and the stock price has reverted back to the mean. It's gone back to its normal or to its appropriate fair valuation. And this one has performed very, very well over that short period of time. The next one we have here is Amgen, which we've already looked at. You're going to see a lot of duplicity in this portfolio. Ameriprise Financial has been performing real well, strong earnings growth, and not much in the way of capital appreciation, but we have had dividend growth with Ameriprise. The next one is Anthem. Anthem was purchased below value. It was giving us nice earnings growth, nice dividend growth, and the stock now is actually technically, by my definition, slightly overvalued, but you see it's performed very nicely. Best Buy is expected to have a down year this year as a retailer, but it is expected to give us some decent growth. It was really undervalued. It's extremely undervalued today, but it's actually underperforming at this point. But again, over time, you can see how the company tracks earnings. The next one would be Borg-Warner. Borg-Warner has been performing beautifully as a business, but the stock price is actually down. This doesn't give us much in the way of dividend yield, but it does give us extreme upside potential in the long run. But again, it's too short a period of time to really be able to measure that. Cardinal Health was really so cheap, so undervalued during this time frame. It actually dropped slightly after we originally decided to purchase it, but now it's in positive territory and it's starting to look like, it's got the ability to start reverting to the mean possibly and giving us some great returns. Cigna, has done just really, really well. It just started paying a dividend. The dividend is expected to stay about the same, but the earnings growth has continued to move forward, and we've gotten good performance out of Cigna so far in this short period of time. Cummins was slightly overvalued, and we talked about that, or I talked about it when I did the video. So it's been underperforming, but it does give us potential to do, well for us over time. FMC Corporation, what we've gotten here with this one, if let's take a long-term view, first of all, we've had, nice correlation of price and earnings. We had this stock undervalued. It's now risen sharply, so we're getting good capital appreciation. Ingredion rose dramatically right after we bought it. Now it's slightly underwater, but earnings and dividends are holding up and doing pretty well here over the time. Lockheed Martin has gone straight up since we bought. Well, it actually dropped initially, and now it's gone up, but I do consider this one overvalued. And I'm emphasizing that because you got to take into consideration valuation, growth, dividend yield. I talked about that in the last video. I already covered Merck for you in the past one. OMC looks, real attractive. It dropped. I think I covered that one. Raymond James had a stock split. I didn't update it, so pardon you for that. Science Applications International Corp, has done really well. Earnings and dividends have grown. This one, has given us good, decent performance. Spire, which is another utility, has just pretty much marked time. Tyson Foods has given us good growth or good appreciation, a decent dividend at 2%. So, then of course UGI, which I covered in the previous video. Whirlpool has been underperforming. This was bought primarily because it was inexpensive. So there you have it. Two portfolios full of, dividend paying stocks. One portfolio focused on capital appreciation, income secondarily. The other portfolio focused on income primarily, capital appreciation secondarily. But both portfolios are capable of producing both. And again, it's too early to tell how these stocks are going to perform. I'm not going to do another update until August, and then I'm going to start doing one a year because I think you want to really give these investments time because it takes time for a business to grow earnings. They only report earnings 4 times a year typically. And, even if a company is growing at 8%, it takes 9 years to double its earnings, which would be how long you should expect it to double your money. If you've got 10% growth, it takes 7 years, and so on and so forth. So, the operating results eventually drive the price. The stock price in the short run is volatile, but in the long run, it's the operating results that matter most. Anyway, this has been Chuck Carnival. I hope you enjoyed this update with the model portfolios. I'm sorry that I couldn't track them as well as I originally anticipated, but I forgot to recognize or realize that since these weren't real accounts, I wasn't going to get the cash coming into the accounts. But I think the visual perspective that you got by following these, the beauty of fast graphs, you can put these buy dots on these graphs and determine, or really kind of audit your decisions over time. And that's something that's really beneficial about this product. So, but anyway, if you haven't subscribed to Fast Graphs, you might want to take a look at it. You can see what a really useful tool it is. If you like the video, give me a like, ring the bell, subscribe to the YouTube channel if you haven't already for more videos like this. And as always, I appreciate you guys, and I'll be talking to you again real soon.